Most of the passive incomes that most of these videos show honestly come with a risk. There's no such thing as doubling your money or getting money with no work. If you want money, you're gonna have to work for it. But if you're dead set on making passive income, these are just a few methods that anyone can get started with today. And on top of that, I'll even show you how to get started. But with these methods, it's gonna depend on how much money you currently have. The more money you have, the more money you'll make. And I'm sure there's more methods, and if I miss any, let me know down in the comments, but these have to be beginner friendly with no work. So these have to be hands off that anyone can start today. Now, the first method is gonna be a simple high yield savings account. This is honestly one of the easiest methods that anyone can start today. Now, most people don't think of this as a passive income method, but the money you currently have today can be making you a return. These type of savings accounts can offer a higher return than most bank accounts. Obviously, I made a video about top banks that you can use, but these are a risk-free method. See, with this, banks are FDIC insured, so this is protection up to $250,000. So to get a positive return with effectively no risk, that's an easy slam dunk. So if you have money that you've been saving up either for a vacation or emergency fund, make sure it's in a high yield savings account. This way it's earning a greater return. And this way, effectively, your money is making money. So with this case, the average return is around 4%. So every $1,000 you have will return you around $40. And to get started with this, all you have to do is shop around with banks and find which one meets your needs. The video that I made covers some of the top banks, and all of them come with no fees. Now, CDs or certificates of deposits would be another form of passive income. And just like a savings account, CDs are offered by your bank. And the return on these are often a little bit higher than a high yield savings account. But the downside with this one is in order to get this rate, you have to lock your funds for a set period. Now, there are ways around this. In the event you need to take your money out, you can find a penalty-free CD. This way, if you take your money out, you won't be penalized. Just like the savings account, you can find a list of best CDs to go with a simple Google search. But it's likely that the bank you're currently with offers them. Now make sure you do your research because some of them have requirements like minimum balance needs. So make sure you pick which one is best for you. So for this example, with a CD averaging the rate of 5%, for every $1,000 you have, you'd have a return of around $50. And to get started with this, you would just need to find a bank that offers a CD that you want to go with and simply sign up with them and deposit your money. But don't forget to look into the fees or any penalties in the event you need to take out your money. And to find the ones with no fees, you can do a simple Google search, and NerdWallet or Bankrate will likely have a list, and you could just pick one of these. Now, another method is going to be bonds. And to simplify this, it's effectively you giving the government or a company a loan. And in return of you giving them a loan, you'll get paid back interest. Now, normally there's a risk of whenever you loan somebody money that you won't get paid back. But with the government, you don't have to deal with that headache because Uncle Sam has a good record of paying his bills. Now, just like CDs, there's going to be durations and how long you want your money away. And based on this, will be how great the return will be. So currently a 1-year bond's around 5.5%. So this is a little bit higher than a CD. So in this case, for every $1,000 you have, you'll get $55 in return. Now to pick this method, there's two options. The first option is going to be going directly to the government website, which is treasurydirect.gov. Now this option will give you the highest rate to lock your money in based on the duration, but remember this locks your money away for the set duration, so if you withdraw your money, you'll get penalized. And the second option will be going through an ETF for exposure. So for this option, you would just go through a brokerage account like Fidelity or TD Ameritrade, and effectively you just be picking an ETF on whichever one you want to go with. Effectively, this method gives you bond exposure, but your likely return rate will be a little bit lower, but you'll be paying for the convenience of always being able to access your money if you plan on selling it. Now both methods have pros and cons. I'll leave a link down below on this ETF.com website that covers all the details. Now these next two methods, we're gonna get involved in the stock market. This one's gonna be investing in dividend stocks. Dividends are just companies that share their profits with you, the shareholder. So if you purchase a dividend stock, a percentage of the profits of the company will be given to you. And this can happen on set periods like monthly, quarterly, or even once a year. And when you get this dividend return, you can either choose to reinvest it back into the dividend stock, or you can just choose to keep it as income. And if you don't want the headaches of choosing just an individual dividend company, you can choose a dividend fund. This way you're diversified amongst many dividend paying companies. In the event one of them goes down, you won't have all your eggs in one basket. But even though there's a risk of the overall stock market taking a hit, the dividend percentage will still pay you out in the event this happens. Now remember, this one's with the stock market, so in the event the value goes down, the percentage yield may still be the same or even greater. But remember, unlike having your money with the bank, with stocks, your money's not fully realized. Until you fully sell out of the stock, your money's still in the portfolio. But you can still consider this as passive income. There are many people that live on their retirement with the income of dividend stocks. But remember, for an expected return, it's still tied to the stock market and it's not guaranteed. But if you were to look at a dividend ETF like Schwab, it has a 4.4% return with a 3.5% dividend. So in this case, you could be projecting a combined 8% return. So for this one, if you had $1,000 invested, you'd be getting around $80 in return. Now to get started with this one, just like a bond ETF, you need to open a brokerage account. Now you can go with whichever one you want, but from there, you can simply pick an individual dividend company, or you can go with the overall dividend ETF. Now personally, I go with ETFs, that way my eggs aren't in all in one basket, but you could pick whichever one you do your research on. And on the dividend payout dates, you can either set it to DRIP, which is the dividend reinvestment plan. That way, every time you get the income, it just goes right back into the stock, or you can just choose to get paid back to your account, which this will be treated as income. Now, either method you choose, whether you're reinvesting it or taking it as income, make sure you're tracking for your taxes. Now, real estate's a method that most people talk about when they're talking about passive income, but personally, I don't treat it that passive. Personally, I think there's too many variables. You can treat it as an asset or liability depending on the condition. But if you want real estate in your portfolio, consider REITs. REITs are real estate investment trusts. And just like ETFs, these are funds that effectively help manage, but in this case, it's for real estate on the stock market. Now, for a company to qualify as a REIT, the company needs to have a bulk of its assets in real estate, and it actually has to distribute at least 90% of its income to shareholders in the form of dividend. This method opens you to having real estate without the personal risks of owning real estate. You can easily treat this as a method of passive income, but just like dividend stocks, remember this is on the stock market and things vary depending on the economy. So make sure you do your research and find whichever one's best for you. But if you were to take a look at top REITs like Reality Income, this is an owner of over 13,000 leases. And I mean, this fund has tenants like CVS, Lowe's, 7-Eleven, and there's plenty of others that include grocery stores and even hospitals. So if you owned a fund like this, you'd effectively be making a profit of all of the deals that it makes. Now remember, the stock market and real estate market vary, but if you were to look at the yearly average return of Reality Income, it has a yearly return of 8.3% with a dividend payout of around 5%. So with this, you could project a total return around 13%. So with this, every $1,000 you had, you could expect a return of $130. But remember, this one's more risky, and past performance does not guarantee future performance. And with your portfolio, as easily as it can go up, it can easily go down. So make sure you do your research with this one. And just like dividend stocks, to get started with this one, all you have to do is open a brokerage account, and you can either choose a direct REIT or a REIT ETF. Just like with buying stocks, there's pros and cons to either. These methods just expand on what passive income is and helps for some beginners. There's no true way of making fast money. With anything, there's a risk. With all of these methods, you can get started at any level, from $1 all the way to $1 million. But regardless of how much money you're trying to earn passively, one thing that can help you more is more active money. And with your income, you don't even need a degree to make an improvement, which if you want to know more about, check out this video where I covered some of the highest paying sectors to get you started.